There is a personal finance debate that never really goes away in Canada, and it gets louder every time mortgage rates move. Should you take any extra money you have each month and throw it at your mortgage, paying it down faster, building equity, getting closer to owning your home outright? Or should you invest it, put it into a diversified ETF, let the market compound it over time, and build a separate investment portfolio alongside your mortgage? Both camps have genuine, intelligent people in them. And both camps have people who will tell you the other side is obviously wrong. The truth, as it almost always is more interesting than either camp admits. Here is what is actually true. In some interest rate environments, the math clearly favors investing. In others, it clearly favors paying down the mortgage. And in a third category, which is pretty close to where Canada sits in July 2026, the purely mathematical difference is small enough that the right answer genuinely depends on factors beyond the spreadsheet. This video walks through the actual numbers, the Canadian-specific tax layer that most coverage of this topic ignores, the one number that tells you definitively which strategy wins for your specific mortgage, and the framework for making the decision that accounts for both the math and the human reality of being a person who has to live with whichever choice they make. Let's start with the cleanest version of this, the pure math, before tax and psychology complicate it. If you want to keep your money mindset sharp and learn how to make your capital work for you, consider subscribing to the channel and liking this video. It truly helps the channel grow and teach people about financial education. Now, let's get right into today's breakdown. Where Canadian mortgage rates actually sit in July 2026, the best 5-year variable rate available is approximately 3.35% to 3.45% at brokerages. The best 5-year fixed insured rate is approximately 4.04% to 4.09% at brokerages. But the average at Canada's Big Six banks on a 5-year fixed is meaningfully higher, at approximately 4.93%. Most Canadians are not getting broker best rates. The realistic range for someone renewing or signing a new mortgage through a major bank in mid-2026 is closer to 4.5% to 5.0% on a 5-year fixed, and approximately 33% of Canadian mortgage holders are facing renewal this year, many from the sub-2% pandemic-era rates of 2020 and 2021, meaning their effective mortgage rate is about to jump by 2 to 3 percentage points with immediate effect on their monthly payments. The comparison that matters: mortgage rate versus expected investment return. Paying down your mortgage is, in financial terms, a guaranteed, risk-free return equal to your mortgage interest rate. Every dollar of principal you pay down saves you that interest rate in guaranteed, certain, zero-risk return. Investing in a diversified ETF like XEQT or VFV generates a return that, over long historical periods, has averaged approximately 7% to 10% annually, but with meaningful year-to-year volatility, no guarantees, and periods of significant negative returns. The pure math comparison at different rate scenarios. At a 4% mortgage rate, paying down the mortgage earns you a guaranteed 4% return. A long-run ETF return assumption of 7% to 8% means investing has a meaningful historical edge over paying down, roughly 3 to 4 percentage points annually, compounding on the invested amount. The math fairly clearly favors investing before any tax adjustment. At a 5% mortgage rate, paying down the mortgage earns a guaranteed 5%. An expected ETF return of 7% gives only a 2 percentage point advantage to investing. And that advantage is not guaranteed, while the 5% mortgage paydown return is. The gap has narrowed considerably, and the risk-adjusted comparison shifts meaningfully. At a 6% plus mortgage rate, paying down a 6% mortgage becomes genuinely competitive with long-run ETF expectations on a risk-adjusted basis. The guaranteed nature of the mortgage return starts to look attractive relative to an expected but not certain market return. Why this matters right now specifically? Canadian mortgage holders renewing in 2026 from 2020 and 2021 pandemic-era rates are moving from effective rates of 1.5% to 2.5% into the 4.5% to 5.0% range. For these borrowers specifically, the math comparison has shifted. The guaranteed return from paying down the mortgage has doubled or tripled compared to their prior term, and the relative attractiveness of investing versus prepaying has narrowed considerably from where it sat at their last renewal. Here is the vault, the one number that cuts through the entire debate for your specific situation. Your after-tax mortgage rate, not your stated mortgage rate, your after-tax account-adjusted mortgage rate. Here is why this specific number matters more than the stated rate. Canadian mortgage interest is generally not tax-deductible for a primary residence. Unlike the U.S. mortgage interest deduction, Canada does not offer this for personal homes, so your 5% mortgage costs you 5% after tax. There is no deduction softening the effective cost. Now consider the investing side. When you invest in a TFSA and earn a 7% annual return, that 7% is entirely tax-free. No capital gains tax, no dividend tax, nothing. The full 7% compounds in your account. This is a genuine, significant advantage specific to investing through a TFSA that the mortgage comparison frequently ignores. The practical implication: when comparing your mortgage rate to your expected investment return, you should be comparing your mortgage rate, say 5%, to your after-tax investment return. For a TFSA investor, the after-tax expected return and the before-tax expected return are the same number. 7% is 7%. Every dollar of it stays with you. This makes the TFSA comparison significantly more favorable to investing than the raw rate comparison implies, because the mortgage cost is 5% with no tax relief, while the TFSA return is 7% with no tax cost. For RRSP investing, the analysis is more nuanced. An RRSP contribution generates a tax refund today, reducing the effective cost of the investment. But withdrawals in retirement are taxed as ordinary income. For most Canadian earners in their peak earning years making RRSP contributions, the net effect is positive if they expect to withdraw in a lower tax bracket in retirement. But it is not as clean a comparison as the TFSA. For non-registered investing, any returns earned in a non-registered account are subject to capital gains tax at the applicable inclusion rate and dividend tax at the applicable marginal rate for eligible dividends. This reduces the effective after-tax return meaningfully and makes the comparison with a 4.5% to 5% mortgage rate more genuinely balanced. The framework in practice: your specific mortgage rate versus your specific after-tax expected return in the account you are actually using. If you have TFSA room and expect a 7% long-run return, compare 5% guaranteed to 7% expected tax-free. The expected return wins on paper at the cost of certainty. If your TFSA is maxed and you are investing non-registered, compare 5% guaranteed to perhaps 5.5% to 6% after tax on the expected 7% return. Now the guaranteed return looks genuinely competitive, and the psychological value of paying down debt becomes a real factor in the decision rather than an irrational one. Let's talk about something the spreadsheet cannot capture: Because this is not just a math problem. The psychological value of being debt-free is real and legitimate. A Canadian who is mortgage-free has a structurally lower required monthly income to maintain their lifestyle, meaning they are more resilient to job loss, health events, and economic stress. The peace of mind of having no mortgage is not irrational sentiment. It translates into real, measurable financial flexibility that a large investment portfolio alongside a large mortgage does not provide in the same way. Both the portfolio and the mortgage are real numbers on a net worth statement, but the mortgage is a required monthly obligation, and the portfolio is not. The sequence of returns risk that the invest always camp underweights. A person who invested aggressively throughout a long mortgage period and relied on a strong market to validate the strategy faces a specific named risk. If the market experiences a significant decline in the years immediately before or after retirement, the portfolio that was supposed to be large enough to carry them into a comfortable retirement is suddenly worth significantly less. A person who also paid down their mortgage throughout has a lower monthly obligation structure in retirement, which changes how much portfolio they needed to build in the first place. The hybrid approach that most financial advisors actually recommend in Canada's current rate environment, given that the mathematical difference between the two strategies is genuinely narrow in the 4.5% to 5% mortgage rate environment, especially for non-registered investors. The most robust answer for most Canadian homeowners is a structured split, not an either-or. A defined percentage of discretionary cash flow goes to mortgage prepayment, and a defined percentage goes to registered investment accounts, TFSA first, then RRSP. A common and reasonable split in the current environment, 70% to investing, TFSA/RRSP, and 30% to mortgage prepayment for a homeowner with significant TFSA room remaining. If TFSA is already maxed, and additional investing would go into a non-registered account, 50-50 or even 40% investing and 60% mortgage prepayment becomes more defensible mathematically. The split is a tool for managing both the expected value calculation and the risk and psychology factors simultaneously. The one scenario where paying down the mortgage should be an explicit priority regardless of the math. If your mortgage renewal is within 3 to 5 years, and you are currently at a variable or short-term fixed rate that may reset higher, aggressively paying down principal now reduces the balance that renews at the higher rate, a specific compounding benefit from mortgage prepayment that the pure static comparison does not capture well. Let's come back to where we started. This debate does not have one universally correct answer, but it does have a clear framework for finding the right answer for your specific situation. Start with your actual mortgage rate, not the best broker rate you saw on a website, your actual mortgage rate. Then determine what account any additional investing would go into. If you have TFSA room remaining, your investing benchmark is approximately 7% expected return, tax-free, and at a 4% to 5% mortgage rate, the math on expected value leans toward investing, at the cost of certainty. If your TFSA and RRSP are both maxed and additional investing means a non-registered account, the after-tax expected return narrows the gap to the point where the guaranteed 4.5% to 5% mortgage paydown becomes genuinely competitive, and the psychological and resilience arguments for paying down the mortgage start carrying real weight. For most Canadian homeowners in the 2026 rate environment who still have TFSA room, a structured split, the majority to registered investing, a meaningful portion to mortgage prepayment, captures the expected value advantage of investing while also building the debt reduction trajectory that reduces long-run risk. It is not the pure math maximum in either direction. It is the most defensible position when you account for both what the numbers say and what it actually means to be a person making financial decisions under uncertainty. The people who argue loudest that the answer is obviously one thing or the other are usually ignoring either the math or the human side. Both matter. The framework accounts for both.